Good morning, guys, and again welcome to my channel. And this is your Prof Zeus. So for this morning, what we will do is we will answer the quiz I gave to my management accounting class at Arellano University. Okay, so I hope this will serve as your reviewer for your preliminary examination. Okay. So let's go through the questions. Management accounting provides information for the use of both external and internal users of financial information. The answer is no. Management accounting is concerned only with internal users of financial information like managers, department chair, key personnel. Okay, they are the customers of management accounting. Number 2. Management accounting is concerned about historical data as it is more on recording of historical transactions. The answer is false. Why? It is financial accounting who is concerned about historical data and is concerned with the recording of financial information or transaction. Okay, management accounting is not. It is not the concern of management accounting of the recording of historic transaction. Management accounting is bounded by Philippine Financial Reporting Framework. The answer is false. Why? It is again the role of financial accounting. Okay, the financial accounting is the one that's bounded by international or Philippine Financial Reporting Framework. Management accounting is not. Next. The controller is the chief accounting executive of the corporation and reports directly to the chief finance officer. The answer is yes. The controller is the chief accounting executive. He is the highest accounting executive in the corporation. And remember the organizational chart of a finance group, wherein the CFO is on top, and then under him is the controller and the treasurer. This is, of course, in order to segregate the money handling from the bookkeeping or from the recording function, which is part of internal controls. Now the question is, will you find the three key personnel in the organization? Answer no, because it really depends on the size of the company. For smaller sizes, you might only find an accounting manager. Okay, there's no CFO, there's no treasurer at all. So there might be some problems in regard to controls. Okay, because the accounting manager is also the one handling the finances of the company, which violates some internal control functions. But there are, of course, some ways on how some mitigating controls, like participation of the owners or someone reviewing the job of the accounting manager. Okay, because the salary of those three key finance personnel is so huge. Okay, that no small or medium-sized firm can afford. Okay, next. Managers' decisions regarding financing, investment, and working capital are reflected in the financial statements. The answer is true. So, whatever decisions that managers make, be it good or bad, will eventually be reflected in the financial statements of the company. Say, for example, it's a good decision. So, what are we going to see? There's going to be profit, stability in the company. But if it's a bad decision, then it could turn around the company's situation from good to bad. Okay, so if we're seeing profit before but now it's a loss, definitely it's just saying that management decisions in the past are not suited for the company. Okay, but it will reflect in the financial statements. Next, the treasurer of the corporation usually reports to the CFO of the firm. The answer is true. As I mentioned earlier, I showed you the finance organization chart showing the CFO on top of the treasurer and the controller. Number 7, an agency problem can arise when the agent of the firm is the sole owner of the firm. The answer is false. Remember that agency problem can arise if the owner and the management is not the same. Okay. Meaning, for example, the business is already huge that requires owners to hire managers to help them run the firm or the company. Now, that is when agency problem can arise because, managers that may be hired, like say, for example, the president and other top level management, may have different, motivations why they are into the company. which may not be the same as that of an owner, because if you're the owner, of course, what you would like to do is to make your money work for you, and you earn your dividends, you earn your earnings from your investment. But the key personnel of the organization, say the president, the vice president, and so many vice presidents, no, and senior level managers may have their own motivations in mind. Like, I should have a very good compensation package, okay, a car plan and all the stuff. So these are costs. So, those benefits are cost actually to the company. So while it benefits, a few of the managers in the organization, they are considered additional costs to the owner of the organization, and it reduces the income of the company, which eventually goes back to the investor. Okay. The treasurer is the one in charge of investor relations. The answer is true. It is the treasurer who is in charge of investor relations. Okay. Remember that the job of a treasurer is to ensure that there is sufficient fund flowing within the organization, so that they will not be able to encounter any backlogs or stoppage in terms of production, stoppage in terms of operations. The treasurer should ensure that there is enough funds, okay, to run the company. And who provides the funds? It's the investors, right? Investors are the one who provides the funds for the company. So that is the responsibility of the treasurer. Next. Assets are the resources owned and controlled by the corporation. The answer is, of course, true. Okay, so assets are resources of the company. Next one. Liabilities are present economic obligations arising from a past transactional event. The answer is true. This is actually the definition of the liability. It's a present obligation that requires the use of resources, okay, and resulted because of a past event or transaction. Next. Shareholders' equity represents the residual interest of the owners of the corporation. The answer is true. So shareholders actually, remember in the accounting equation, asset is equal to liabilities plus equity. So if you would like to get the shareholders' equity, that's going to be assets less liabilities, which means it is the owners of the company that will get the last portion of the pie. So if, say for example, they have a huge amount of liabilities, so chances are they will be getting less. But if they have few liabilities, who will share in the assets of the company in the event of liquidation, then they will get more assets of the company. So the answer is true. Next. A statement of cash flows showing that the cash were provided solely by investing activities is an ideal kind of cash flows. The answer is false. What we would like to see in the statement of cash flows is that the funds or the cash flows are provided by operations, because it is only when the cash flows are provided by the operating activities of the company that we can say that the company has a stable operating condition. Okay, because if these are actually coming from investments or even in terms of financing, kasi investment, ano ba investment? Nagbenta sila ng assets nila, right? Like they sold equipment, and that is not an ideal situation where companies would sell their equipment, because they're using equipment to produce goods, right? So if they sell it, what will they use in order for them to be able to continue the business? Okay, so the answer is false. Next. The company's financial statements is used by different interested users within and outside the company. Within and outside the company, the answer is, what do you think? The answer is true. When we speak of financial statements, okay, they are being used by inside or outside parties, okay? But when it comes to management report, it's only the internal managers who are privileged to see the report. Management accounting is future-oriented. This is true, okay? This is true. Remember what I said earlier, that management accounting is forward-looking, meaning, like say for example with our topic on budgeting, probably for midterms or finals, okay, we are budgeting for the future, we're not budgeting for the past. Okay, so the three key finance officers, CFO, controller, and treasurer, are always present in every organization, big or small. I already answered this kanina. The answer is false. Okay, you will be able to find these three finance officers in big organizations or corporations like listed company, perhaps like BPI. They certainly will have their CFO, controller, and treasurer. But for small to medium size, or micro to medium size, will not have these three key personnel because it is very costly for them to maintain three key finance officers. Okay. The treasurer should ensure good relationship with banks in order for the company to have available credit line should the company need one in the future. The answer is true. Banking and investor relation is under the treasurer's function. Okay. Reason being, of course, the treasurer is in charge with financing, ensuring that there's enough financing for the company's operation so that the company would continue to operate, to manufacture goods. Eventually, they will dispose of these goods. That is the function of the treasurer. And banks, okay, is definitely the one that can provide, capital to augment the working capital of the company, or the funds for the company to augment its existing working capital. Okay, so it is under the treasurer's function, and they should ensure that they have a good relationship with this with the banks, for them to have that available credit facility, so that if they will need something in the future, then they have a ready credit facility. Next, liabilities that are payable beyond 12 months from financial statement date is called long-term liabilities. This is true because the payment is beyond 12 months. Remember that when you speak of liabilities, if they are going to be paid within 12 months from balance sheet date, then those are considered current. But if they will be paid beyond 12 months, then they are considered non-current. Okay? The statement of cash flow provide information on the profitability of the business. The answer is false. Remember, what statement provides information as to the profitability? It's the income statement, okay, or the statement of performance. Okay, not the cash flow. The cash flow statement would show the users of financial information, the cash inflow, and how this cash were used by the company, okay, to operate the business. Number 20, a company with negative operating result shall always show a negative cash flows. Answer is false. Why? Because remember, one of the expenses, okay, one of the expenses that is recorded in the company's historical books, company's books of accounts, is depreciation. Okay, so depreciation is what? Depreciation is a non-cash expense. Okay, and that if the depreciation is so huge, then it will reflect, the company might reflect a net loss in the statement of income. But in terms of the statement of cash flows, remember that we reconcile in the operating activities under the indirect method of preparing the cash flow. We add back all the non-cash expenses. Right? And a example of non-cash expense is what? The depreciation expense. So if we add it back, then we are now reconciling our accrual based financial report to what? To cash basis. So the loss, okay, that is showing in the statement of cash flows as the first item, in the operating activities, might be reversed when we add back the depreciation. Okay, let's have the other one. I think there are two, no? Okay, let's have the other one. Continuation here. This is fairly short. Okay, so let us answer. I may need to have my my calculator, okay, because I guess this is problem solving. Okay, let's have the second one. Lionel has a current assets of 623,122, including inventory of 241,000, and current liabilities of 378. What is the quick ratio? Okay, what is quick ratio? Remember, quick ratio is what? Quick assets divided by current liabilities. And when you speak of quick assets, these are what? This includes your cash, company's cash, receivables. That's it. Inventories, prepayments are excluded from what we call as quick assets. Okay, so our formula for quick ratio is what? That is liquid asset or quick asset divided by current liability. So therefore, yeah, we have here the current assets including inventory. So we will deduct the inventory from the current asset. Okay, so that's 623,122 minus the inventories of 241,990 divided by current liabilities of 378,454. Okay, so how much is the quick assets? That's 623,122 minus 241,990. That's 381,132 divided by 378,454. So 378,454. So the answer is 1.007. 1.007 or 1.01. This is the answer, 1.01. Okay, because we just round off 1.01. Okay, number 2. JCL Corp has receivables of 334,227, inventory of 451,000, and cash of 73,913, and accounts payable of 469,553. What is the current ratio? Okay, current ratio is what? Equal to current assets divided by current liabilities, right? So therefore, the current assets are already given. Current assets will be cash, receivables, and inventory. So we just add them all up. That's 334,227 plus inventory of 451,000. Sorry, I'm having difficulty in seeing the figures. And cash of 73,913 all over accounts payable of 469,553. Okay. So how much is the current asset? 334,227 plus 451 plus 73,913. Total current asset is 859,140 divided by 469,553. 469,553. So the answer is 1.829. Let's look for the answer. 1.829, or we can round this off into 1.83. The second one, 1.83. Okay, let's submit. Number 3. A front of corp has accounts receivable of 654,803 and net sales of 193,2349. What is the accounts receivable turnover? Now, what is the formula for accounts receivable turnover? So AR turnover is equal to what? If you're given the figure for credit sales, then use that. If not, then use the total sales. Okay, so that's going to be sales divided by, again, if you're given receivables for 2 periods, then you use the average receivables. So therefore, sales is 1,932,349 divided by accounts receivable. So we're given just one period receivable, 654,803. So the answer is, so that's 1,932,349 divided by 654,803. So that is 2.95 times. So there is 2.95 there. Submit. Okay, let's have number 4. I think I gave you only 5 questions, so 5 computation part. So expect in the preliminary exam. Okay. The conventional way of preparing a balance sheet is to list all assets in order of. Okay, when you prepare a balance sheet and you are preparing the current asset section, we always present the current assets in order of liquidity, or what is liquidity when it comes to current assets? We are showing them based on the nearness of the item, okay, to cash. Okay, so that's why we are presenting cash as the first item, and then receivables, and then inventories. Why? Because receivables, it's near to cash. Just call the customer to collect, then you convert the receivables into cash. But when it comes to inventory, you have to sell it first, right? You have to sell it before you can convert it. So if your customer will buy the inventory in on credit or on account, then you have to wait for the customer to pay. So it could take months. Okay, that's why inventory is third in the line. Okay, so therefore, okay, which of the following is not a tool in analyzing financial statements? Okay, so you have common size. In the analysis of financial statements, remember we mentioned about the horizontal and the vertical analysis, and of course the financial ratio. So when you speak of horizontal, you're looking at your horizon, then you are now comparing from one year to the other, or the budget against the actual. So what are the and of course say trending, okay, you are getting the trend of the financial statements from one year to the other. So let's have the choices. Common size financial statements, okay, that is true. That's a tool for financial statement analysis, no? And it's what? It's more on the vertical analysis, where you express the items, no, as a percentage of total assets for assets, total liabilities and equity for liabilities and equity, and total as each item in the income statement as a total of what? Net sales. No? So if you have gross sales, then gross sales will be equal to more than 100%. Okay? So what's given here are common size, that's true. Trend analysis, that's true. That is what? Horizontal. So common is vertical, trend is horizontal. Then you have the financial ratios. And the last one, all are tools. That is the answer. All the given items there are tools in analyzing financial statements. Okay? So that's it, guys. I hope you will be able to you are able to learn from the exam. It's quite a short exam, okay, but I wish you are able to apply the concepts that I taught you during our class. Okay, so that will be part of the coverage of our preliminary exam. Okay, so please study again. You can always go back to the lecture videos I posted in our LMS. Okay. Thank you, guys, and again, good morning. It's about what? It's 5:43. I was actually up at 4 o'clock, and trying to take advantage of the silence of our place. Okay, because it's early part of the morning here. Okay, thank you very much for watching, guys, and hope to see you again in my future videos, okay, regarding accounting and finance. Again, this is your professors, and if you can probably invite your friends who are taking accounting, they may want to watch my YouTube videos for financial accounting, management accounting, tax, okay, and auditing. I would like to help them in my little way. Okay, thank you very much, and good morning. Again, this is your professor signing off, and I'll see you again later. Thank you.